If stock market investing is not exciting enough for you, or if you think the 200% return that you got from Amazon is not enough, or Tesla returning 800% to your portfolio is not enough, I have something exciting that you may want to consider. It's something called angel investing, something in which I've participated for the last several years. I'm really interested in the space because I wonder what it would be like to invest in Amazon or Google or Tesla when they're just thoughts and ideas. And just imagine, look, having your money just, I mean, you can't imagine even the returns. So the 800% return, the 200% return on Amazon, yeah, you may get in a little bit late, but there are other opportunities out there for the right type of investor. So, for those of you who don't know me, my name is John Lin. I'm a urologist in Gilbert, Arizona. I'm very excited today to have Romi Dhillon, who is the managing partner for Arizona Founders Fund. This is a fund in which I've participated for the last several years. I've sat in pretty much every single one of the investment committee meetings, listening to pitches, and I'm really honored to have Romi on the program. We are going to talk about angel investing, what it is, how do you get involved, and the who, what, where, and what, why of angel investing. So thanks for coming on the program, Romi. All right, let's get right into it here. I got your sound going. Sorry about that. Let's talk about what is angel investing for those who are not aware of what is angel investing.
Right. Angel investing is when you write a check into the earliest stages of a company for an entrepreneur. We love to call them founders. Those are technologies that are disrupting their industry. And we really, encourage more and more accredited investors to get involved and see these returns that you're talking about, John, by, being a part of the earliest days of a company. So it's investing in disruptive technologies before they actually disrupt the entire industry.
Yeah, so kind of like when they're just an idea someone thought of, and they may have built a minimally viable product or MVP, and then they have something to show to potential investors. And it might be an idea that resonates with you as a potential investor, and you like the idea, or you like the potential upside of making a lot of money on the back end.
John, that's exactly right. There are only two reasons to get involved in angel investing. You might have the appetite to want to make an impact, or you might have the appetite to want to see X factor returns. By X factor returns, I mean 10x, 15x, 20x. And the third is you want to have the best of both worlds. So, where you can make an impact and see the biggest return for your dollar. And that is why angel investors do participate at these deals that are sometimes, if you have the appetite, an idea on an envelope. They are just a PowerPoint deck. There could be a very simple product with or without customers. It really has to do with what your appetite is for risk, but also that goes hand in hand with the return profile you're looking for. And if you are really trying to make an impact with either providing your knowledge to an entrepreneur, investing in, if you're a healthcare provider, writing checks into the healthcare industry, just where do you want to make an impact in your community? So those are the two reasons, primarily that, angels do participate.
Now, you mentioned early on about accredited investor. That's a very important concept to grasp. Why don't you tell us what is an accredited investor and why
Sure,
that
more than
matters?
happy to. More than happy to, John. So the accredited investor is a designation that's really important. It's actually a requirement for anyone who gets involved in angel investing. You must have a minimum net worth of $1 million, excluding the value of your home, or if you're one person, annual income of 200K or a combined income of 300K. And if you meet any one of those designations, the net worth or the income, you can then be qualified as an angel investor and you can begin to participate according to the Securities and Exchange Commission regulations.
Now, there are other ways to participate in angel investing that does not require one to be an accredited investor. But for the purposes of our discussion today in the Arizona Founders Fund, it does require that you be an accredited investor.
There are many other ways that you can participate. There's obviously crowdfunding. There are campaigns online. There are many different paths that you might have to be able to participate. But, for our conversation today, to get involved in technology and these spaces, in particular with regard to an asset class, alternative investing, angel investing within the spaces that you obviously are, John, and Arizona Founders Fund, you need to be an accredited investor.
So, how does someone actually get involved? When I had a tough time, believe it or not, before I found Arizona Founders Fund, I had a tough time trying to figure out first of all, what is angel investing and where do I find these angel investing deals in my area? So, how does one get involved? For instance, what are the various ways?
Absolutely. So, there are a few routes that one can take to be able to participate in angel investing. One is to get involved in your local angel group. There are 100 at least angel groups nationwide. Some towns and municipalities that have really frothy technology communities have more than one. They might have 3 or 5. Boston, for example, has 10. Salt Lake, Provo, Park City, scattered amongst there is 5, angel groups. And of course, Silicon Valley has, well over a few dozen. So one is you just search for one and join one that is within your within the region you are looking to write checks. Now, if you join your local angel group, you're likely going to write checks into local startups, because they're trying to bridge the gap between startup companies and capital, and that's why they form, so that they can provide X factor returns because of the startups that exist in your town, but cannot see capital unless it's because of your group. You also have Angel List. You can participate there, and there you can join a syndicate. That's other managers, such as yourself, John. If you wanted to create one on Angel List, you can create a syndicate. Other angel investors can look at your documents and be able to join there. It is a tough thing to do if we look at towns like ours, where we have a lot of belief about the fact that this should be a gigantic, booming technology opportunity, technology town. How can there not be more than 5 angel groups here in the region? And there are challenges to trying to get in, because if you don't have an active angel group, or maybe one that meets your appetite for wanting to write checks and get involved, where do you look? It is hard to find the deals. These deals tend to go to either managers who are locked into the space or angel groups that are writing checks there, if they even go to their local angel.
Yeah, the way I think of it is you almost kind of have to know somebody to get into some of these deals if you want to directly invest in startup companies, or you leverage the knowledge of someone like you, Romi, who has industry knowledge, who has the connections and the insight on how to evaluate these companies, and then somebody can invest through you and get in on the upside of some of these startup companies. There are also syndications, and there are other ways to get in through online deals that does not require someone to be an accredited investor. But for me, the way I think of it is, I personally don't have the time to look at every single deal. Right now, I'm looking. You and I are both looking at this one particular company. The document is 33 pages long, the offering. So I'm going to have to wade through that, and make sure you understand all the jargon, the safe, and then the convertible notes, and the market caps, and the valuation cap, and the discount, and all that stuff. So engaging in someone with like Arizona's Founders Fund through you is that you take a lot of that risk away from me, and I can simply invest the money through Arizona Founders Fund, and then have the fund itself look at the different deals, and you can be as involved or as uninvolved if as you wish. For instance, I'm very involved.
John, you're one of our biggest champions. You've been there early on. When the fund was just an idea on a napkin, you were our champion. We were that early. And that's really, I mean, there's no other way to put it. You are an angel in Arizona Founders Fund. So, I think that that's something where to write the check that you did alongside with our other 32 investors who wrote checks into Fund One. One needed to see that the Arizona opportunity was one that they wanted to be a part of. Two, they knew that the impact they wanted to create was to write larger checks that can happen through a fund, as opposed to an angel group that writes important checks, but maybe not as large early on. And we know what that does. The larger your check, the more equity you might be able to get on the fund side. Then the more upside of a fast growth company you'll have farther down the road. So I do think, John, that, there is a lot of work. I mean, for anyone who does write checks into Arizona Founders Fund or into another manager in their region, they likely don't have the time to do the due diligence unless they are compelled to have to participate in every due diligence meeting, in every impact meeting with the founder. When a founder is having a problem or a management issue, an angel will likely say, hey, I'm an angel. This is why I'm doing it. One of the reasons I'm involved is I want to make an impact and I want to work with an entrepreneur every single day. Many of our investors say, I want to make sure that Arizona is a booming technology industry. We will grow significantly over the next decade to 2 decades. I want to be in on the ground floor. This is my way of participating. But still, that's the impact I want to make. I don't have the time to do the due diligence and read all the documents associated with it.
Yeah, definitely. And for those of you who are watching this live, please feel free to ask any questions you may have. And if you're watching this on a replay, certainly leave any questions you have in the comments. We are talking with Romi Dhillon, who is the managing partner for Arizona Founders Fund. We are here to educate and inform potential investors about what is angel investing. So let's get back into Arizona Founders Fund. Why? So Arizona Founders Fund is kind of unique. We don't invest in every startup potentially in the country or in the world. We concentrate on Arizona startups only. Can you tell us why?
Exactly. I think that decision we made early on to be committed only to Arizona entrepreneurs is one that I think separates us pretty clearly from all the other managers that are here and in the mountain region, of the country. And there were a couple interesting reasons why I think, John, there's been a incredible legacy of technology creation in Arizona. For 50 years, we have Grand Canyon University, University of Phoenix, Microchip, Burr Brown. I begin naming all of these companies, and you can't help but wonder, wow, I mean, that's pretty impressive. But what else has happened? How about in the last 20 years? There's been GoDaddy, Carvana, LifeLock, Keep, WebPT, and over 100 companies have gone on to be acquired or be worth over $100 million just here in Arizona. But what happened? There was not a seed fund that was created to invest in the next few hundred entrepreneurs. It just became a conundrum, and this is the same thing that I shared with all of my champions early on, is the fact that we're the 5th largest metro. We are the fastest growing metro in the country. We have more public technology companies than any other state in the Rocky Mountain region. We have more than the second highest GDP, of all the Rocky Mountain states. and over 2x more than R&D investment by the federal government into Arizona than any other Rocky Mountain state. So explain to me how we don't have a seed fund. I thought it was easy enough. We just had to form one, and we just have to be in it for the long term. And that's why Arizona became interesting enough to write, checks into. And plus, I looked at my experience. Prior to Arizona, I was part of a team that was writing checks into Utah, and Utah does not have any of the upside on demographics, on R&D investment by the federal government, on public technology investment, none of those things. But still, they have 4 or 5 technology unicorns in the last 5 years. I attribute that to early stage capital formation. That's just seed funds. And I think that here we can do it here, John.
Yeah, basically, essentially, Arizona Founders Fund is kind of like a startup in its own, because you saw the opportunity, an unmet need that has a lot of potential, and then you formed a startup fund, if you will, and then you got rallied a bunch of investors, and now we actually are wrapping up Fund 1, as you kind of alluded, and now we're getting into Fund 2. So I want to talk about a little bit about all the exciting companies and ventures that we've gotten into over the last, I think 5 years, right? Time flies.
5 years. 5 years, 5 years, John. We are 4 years into investing, but the fund is young. But we've been able to make a lot of headway. Just in terms of our gains, the deals that we're writing, and just the growth that the portfolio has seen. That's been pretty great.
Yeah, it's first of all, for me, sitting in all the investment committee meetings, there's so much information and so much opportunity out there. It's incredible. And what I appreciate sitting through those meetings is that you and your team have kind of cleared the way of just bringing the potential high value companies and startups for evaluation. So I don't have to kind of screen out all the companies with less potential. I'm only looking at the cream of the crop, and looking at really, really interesting and exciting technologies from all sectors. It's amazing what the Arizona founders have created here in this area, in this space. And just when I thought, okay, well, there can't be anything more exciting than this, there's so much stuff out there. It's really, really exciting. So let's kind of go over some of the companies that we've kind of evaluated that are exciting in the last 5 years.
Sure, I think that would be great, John. I'm excited to do it.
And what about, that's probably the easiest would be to kind of discuss some of the portfolio of companies in which we've invested.
So here's what's been really interesting about our portfolio companies, John. I think that, when we look at the portfolio, we have invested across the board into 10 companies. 9 of them are going concerns. We had one that was a rocket, but it ended up just losing fuel, and that happens. I mean, that's why we write checks at the earliest stages, and we did shut one down. But while we shut one down, 6 of them just started really taking off. And pound for pound versus the other funds that I have invested in, our Fund 1 is extremely competitive and producing what I think are outlier returns for all of the investors who are involved in it. And this is really surprising. We have invested into 10 companies, and these were 10 of the 300 that we evaluated. And on 12/31/2020, John, we will have brought in 137 companies into our committee meetings. 137 that we have filtered to come in from the 300 that are in Arizona right now. Now, that is the thing that I didn't know. Remember, it was like 3-4 years ago, John, when I said, you know what? I gave you that whole spiel about I think we have a lot of deals here. I think that we can really grow. I'm just going to be bullish on Arizona. I think we can really get it done, and we're going to have more entrepreneurs than we ever thought. At that time, I gave you a data point that we have 160 companies that are qualified to raise capital here. They have no place to go. Well, that number was actually 2x what it was at that time. Today, it is 300 companies.
Wow. So this is what's impressive, right? There are 300 opportunities, and then you kind of funnel that down to about 130 that we actually sat down, evaluated, listened to the pitches, and then out of that we invested in 10. And I'm actually really surprised at how successful we've been in picking these companies, because 1 out of 10 not taking off is, like you said, an anomaly, in the angel investing space. So a lot of credit to you actually and your team for being able to see the value in these companies and critically look at the infrastructure, the value proposition, the total addressable market, and the potential returns.
Well, that's what everyone says, John, when they get involved in venture capital. We all know what that rule of thumb is because we've heard it for over 20 years. You're going to write off 9 of your companies, and that one company is going to be that home run for you. How are you going to pick that home run company, Romi, or any other manager out there? I think that what's been really, really interesting here, John, is the fact that our portfolio is the inverse of that data point.
Yeah.
We have only written off 1. But the other 6 are going to provide gigantic returns, to the fund. So what does that really say? It says to me that the one thing that I wasn't quite prepared in my first pitch, to you and the other 800 pitches that I made from 2015 to 2018, and that was, John, that Arizona founders are prepared to leverage and use venture capital. Our job is to provide them with the venture capital. That I was not prepared to say just because we didn't have enough data points. But we can say across the board in our portfolio, 6 of the 10 companies are at $1 million or more in revenue. 3 of those 6 are at 3 million or more in revenue, and 2 are at break even. So they are growing like weeds. They're growing very, very fast. And these founders know they are just pound for pound, extremely, extremely competitive with any other founder who I have invested in any other region, during my career. So I do think that, we have a moment where we can take that off of, the table in terms of our Arizona founders ready? Can they build gigantic companies here? That's absolutely true. They can, and all they need are more investors and more capital, like us and others. Can we bring more friends to the table to write checks and create these X factor returns, for ourselves and be able to get entrepreneurs to grow really, really fast because they're dealing with competition. They have to make hires and they have to get through really, really tough moments. And it takes capital to be able to do that, in addition to grit and guile and a really hard working mindset.
Yeah, definitely. And for those of you who are joining us just now live, please feel free to ask any questions. I'm online with Romi Dhillon, who is the managing partner of Arizona Founders Fund, a fund in which I'm invested. And we've been looking at deals for the last 5 years or so, and we are about to end that fund and start Arizona Founders Fund 2, which may be an opportunity for some of the audience to join. Can you tell us some of the goals of Arizona Founders Fund 2?
What's been really interesting, John, with Fund 2 is we are looking to do exactly what we did in Fund 1, but solve the problems for more entrepreneurs on the capital formation side. Entrepreneurs don't quite think this way when they meet us and when they meet Arizona Founders Fund, but like you appropriately said early on, we are absolutely a startup. And what is our constraint? Our constraint is the size checks that we can write. Our goal is that we should be able to meet with an entrepreneur, be able to deliver on a value proposition, which is providing smart capital to them, and write a large check that's commensurate with the due diligence that we do. There's no question about it. I think the reason we have a fast growing portfolio is because our diligence and the way we filter and screen companies, and we can screen amongst 300 companies. I think that it does help us make the best decision possible. That's one. 2, John, you've evaluated hundreds of companies with us. Our committee has our entire investor base has been a part of that as well, right? We now have figured out how to be able to do that extremely efficiently. And it only makes sense that we can create more returns, better returns in a market that is growing very fast. I mean, it is my estimation that the number of companies in Arizona is going to exceed 1,000 by 2025. These are 1,000 startup companies. There's no question that one of them will be a GoDaddy, a Carvana. We might be invested in one of those right now. We don't quite know right now at this point. But I think, John, you know, uh, we have figured out decision making on the investor side of the table is a muscle. We have exercised it a lot. I think it makes sense that we need to continue to do that because we make decisions pretty well at the Arizona Founders Fund. And the other interesting thing, too, John, is we're going to open up the purview a little bit. Arizona Founders, the state of Arizona is one of 37 states that has to fight for less than 10% of venture dollars invested nationally. That's a lot of, the elbows get really sharp, there. And it doesn't make sense that they should get sharp, with founders in Nebraska, New Mexico, Nevada, Idaho. And we've been receiving a lot of inbound traffic, from there as well. And I think it makes sense for us to be able to have a carve out where if we know how to make decisions, if we make decisions really well, on the fund side, and we've been able to flex that muscle in Fund One. Maybe we should take a look at other deals from other states where they're just thirsty for capital, but they absolutely have the ability to be able to grow fast because they've been able to do it without capital. So those are the two things. We're going to write larger checks, we're going to open up the geographic purview, and we're going to double down on Arizona.
That's awesome. So excited for Fund Two. Jackie asks, is there a minimum investment amount?
A minimum investment amount for Fund Two will be 100K.
Awesome. And Holly asks, how about a pitch worthy for further research and possible investment for a non-resident? Great concept. Okay, so that's awesome. And Cindy Barnes, you may remember her from the Vet Software. Yeah, she
Right.
says hello.
She's great. Hey,
Yeah.
Cindy.
Very good. So I'm really excited for Fund Two. Certainly, Arizona Founders Fund 1 was kind of like a little concept, and it has proven itself, right? You provided traction. Now now we're just creating a different entity that is similar, but a little bit more expanded in scope. Now that we've, like you said, worked out our muscles, and we are extremely efficient in looking at deals and saying yes or nay, and then moving forward or kind of watching or just completely saying no.
I mean, John, that's the interesting thing. You said it early on when we raised the fund, Fund One. It was very much an improbable concept. Anyone who wrote a check into AZFF, they were writing a check into unproven and unknown commodities all across the board. One, we didn't know if we had the deal flow. Two, if we had any deal flow, would these companies return the fund? That's the mindset you want to have. First, as an angel investor, you're getting involved 0 and 10, 15, 20K is what you're comfortable with. You're of course looking for the upside. But as a fund manager, you want to look for a fund manager who says, I am going to return your preference. Your preference is you're going to get your money back because once you get your money back, the management team will then be able to participate in the profits. I didn't know if that was quite the case or not. And then I was very much an unknown commodity at that time. I came down from Utah, singing the song of Utah down here in Arizona. I'm a Midwest guy. So I come from Northeastern Ohio. I said, hey, I didn't go to high school here. I didn't go to college. None of those things happened. But I do believe that something here, there's a there, here. And that's the thing, John. Now I've been able to remove myself from the equation. We've been able to remove everything from the equation and just say, we have 10 companies that are doing really well. We have spectacular entrepreneurs in Arizona. And There are hundreds of entrepreneurs, more to come in Arizona and in this entire Sonoran region over the next 5 to 10 years. And these are the returns that we think they're going to create. That's why you should get involved in this fund.
Yeah, definitely. And you kind of alluded to the fact that there's no guarantee that you are, the biggest risk that you take as an angel investor is that you have the small risk of losing everything that you put into the fund or put into a company. But that is it should be a calculated risk, and it should be a small part of your overall net worth, overall portfolio of investments. And but the upside is that I want to, if wherever I put my money, I want to have the opportunity to maybe once in a while or rarely hit a unicorn like a Amazon or GoDaddy or stuff like that, right? Go ahead.
I'm John, so there's a couple of things here that I think are really, important. So getting involved in angel investing, I think that goes hand in hand with after you've made the decision to be able to write the check, then the natural question is, well, how much do I get involved? And just in terms of portfolio diversification and portfolio construction, I'm not a financial advisor, so I'm not giving advice. These are just heuristics and rules of thumb. 2.5% could be allocated if you're an accredited investor into angel investing or into venture capital. That way you can at least be able to see the benefits of an X factor return and having it ripple effect over across your entire portfolio to really see it get, just being able to create more economic rewards for you. So I think one of the places that you would like to begin, or any angel investor is just say, I know I'd like to make an impact on an entrepreneur's life. I can do that by writing a check, and I'm willing to write something that is, invest over 4 to 6 years, maybe 1% of my overall net worth. That is how the math can start to work and how you can begin to participate while not putting the entire portfolio you've worked your entire life to build at risk at all. Remember, it is risk capital. It is X factor capital. And these X factors can come and be able to double the size of your portfolio. But if they don't, and that's the math that we're working with here, it doesn't hurt your portfolio overall. So just keep that in mind as you build the actual allocation that you're looking to write checks into venture capital.
Yeah, but so what financial advisors tell me that you should diversify your portfolio. Same thing with angel investing. If I invest in just one company, I have all my eggs in one basket. But if I invest in a fund, that fund has multiple companies in the portfolio. So in essence, I'm diversifying my risk. Plus, I have someone with experience kind of looking at these companies, helping me make the better choices.
John, that's exactly right. What is the one truth? And just keep this in mind, everybody. The one truth you have when you are getting involved in angel investing is the moment you write a check, it is not your last check into a company. Because companies that raise venture capital need to raise more venture capital. Why do they have to raise more venture capital? Because they're growing. And these are companies that are hitting exponential growth. They have to invest more into technology. They have to invest more into software, into expanding their teams. They may have to make a major recruit that costs capital. All those things are reasons why your companies may come back to you and say, thank you for your first check. It helped us triple in revenue. Now I need you to write another one. Well, how do you evaluate that? That's what we do at the fund. So as you know, John, although we're invested in 10 deals, we've made 30 investments because there is the 10 checks that we've written early on, then the other 20 are all follow-on. And how do we make that assessment? How do we write those evaluations? That's what we have been able to do, I think, pretty well at the fund, and the committee has just done an incredible job at doing over the last 4 years.
And I tell you, sitting at the table with that committee is just really humbling. The variety of skills and the background and the knowledge is. I mean, we have lawyers. We had a couple of lawyers. We have people in people who had CPG space experience. I mean, CEOs and board members, that have just kind of retired and they're just sitting there and just providing amazing insight. You said about you mentioned something about the things that you look for, and Dr. Wallen asks, can you talk about what you look for and how you evaluate a startup, which is a very, very fundamental question. So, I guess fairly simple things that we look for. Number one, is it a good idea? And also, what is the total addressable market? Is this a worthwhile idea to implement? And is it solving? Are you addressing a problem that the world has, or the niche has, that you are trying to solve, and how good is that solution? And then we also look at the jockey, the founder or the founders, and how they have, what are their credentials and background experience, and I believe also we kind of look at the traction that they've already had in the startup that they've created. Obviously, if they're already making money versus before they started making money, we call that pre-revenue. If they have some monetary income traction, that's always a plus. Romi, what else do you look for in a startup?
I think that this is where, John, we just run through the checklist that we do at every committee meeting. And I think it's pretty easy for us to determine a fit, what moves to the next level of due diligence, for us. So the very first is, are they based here in Arizona? Because it's explicit in our charter. In Fund One, we invest in Arizona. Two, is it disruptive? Disruptive is technology, either software or healthcare IT or a medical device. Three, are we the very first institutional investor? There are times when, in half of our portfolio, we have been the first institutional investor. And, the other half, we have been the first in, kind of as a part of a group of institutions who are writing checks into a company. And I think after that, the final is the founder. Is the founder a subject matter expert who brings in 5 years of experience and really knowing all of the wrinkles about who are they selling to? Overall, though, we do not make a requirement that a founder has to be a 2-time entrepreneur or a 3-time entrepreneur. In fact, we tell every single founder, don't worry if you haven't done it before. Jeff Bezos, Bill Gates, they were first-time founders as well. You're actually, following in great footsteps if you are if you are a first-time founder. And we can look at our local entrepreneurs too. The founders of WebPT, of Key, of LifeLock, all of them, first-time founders across the board. So, we just need to find, the next entrepreneur that will then be the deal that will meet that fit criteria, and then be able to move to the next stage of diligence. And diligence is what you talked about early on, John. How do we feel about the market? How competitive is that market? Is the market fast growing? If it's not a fast growing market, then they will likely have to succeed by providing world-class customer service. If it is a fast growing market, they will succeed by winning on speed, happiness of the customer, and also on pricing as well. So we get to help an entrepreneur figure those things out. But ultimately, our job at the fund is to return investors their capital first. And keeping that in mind, that's where the jockey and the horse and the track all, really become, crystallized during that due diligence process.
Yep, the track and the stadium.
Yeah. I mean, John, you can have a great jockey and a horse, but if it's got to run up Mount Everest, it just doesn't help you, right? I mean, we really have to make sure that the track is primed for that particular, for the rider and for the horse, who are going to be going around it, because everyone else will be participating in that same race too.
Yep, and then I think of the track, the stadium and the audience as the customers.
That's exactly right. That's exactly right.
Perfect. Well, we certainly covered a lot, Romi. I really appreciate you taking the time on a Saturday to give our audience such insight. What do people do if they're interested in investing in Arizona Founders Fund 2?
Absolutely. So I think one is, you can find me on LinkedIn. Reminder Dhillon, Arizona Founders Fund. You can send me a message there. You can connect with me. You can find me at Reminder Dhillon on Twitter, and you can send me a DM. AZ Founders Fund has an Instagram handle. You can DM me on Instagram as well. You can also be able to hop onto Facebook, look for Arizona Founders Fund, our public page, and be able to reach out to me directly there. You all know John as well. John's, our champion through and through. If you have any questions, be able to, forward them to John, and John will share them with me. He's also extremely fluent at being able to answer a lot of these things, and give you clarification on next steps with me and so on. But John can be able to make those, connections with us as well. So I try to make myself available on all platforms across the board. You can go to our website, azff.co, and fill out a contact request form, and we'll set a time to talk, and I can walk you through what the opportunity looks like and what our results have been to date.
Romi, thank you again for taking time and sharing your knowledge and insight.
Thank you very much, John. Thank you for the opportunity, as always.
Exciting times ahead for Arizona Founders Fund too.
Yeah, for all of us. Great.
Yep.
Thank you, John.
And thank you so much for watching. If you have any questions, comments, feel free to leave them below. I look forward to seeing everyone again soon. Bye-bye.